DeFazio, and I'm joined today by Stewart Willis. He is President of Asset Preservation Wealth and Tax. Stewart, how are you today?
I'm doing awesome. How are you doing?
I am fantastic. I'm always excited to see you in the studio because I know we have so many important topics to cover. Today specifically, current state of the economy and tax planning and how to know if someone's diversified. So wow, what a show.
Right?
Right? So how have you been?
Oh, swamped. I mean,
Yeah.
listen, I say it every episode that I'm a man of leisure, but clearly can't live that life right now. I'm going to have to put that on hold for a little while until everything clears up. But no, I think we're seeing just incredible amounts of volatility. I mean, just craziness in the market right now. And obviously it's stimulating tons of phone calls from, from clients. And, it's keeping us busy.
Most definitely. And obviously, speaking of volatility, what is causing this volatility, Stewart? What's happening?
Yeah, I mean, quite simply, obviously, it's the federal funds rates. The Federal Reserve Chairman, Jerome Powell, obviously came out and said he was going to raise the interest rate 75 basis points. They did that. The market didn't like it. We kind of knew that it was possible, but, it's been a long time since they've seen anything like that. So what we're seeing here is obviously the thought of inflation, right? Inflation is real. It's hitting us hard. We just got those statistics for the CPI of 8.6 to 8.9%. So the consumer price index is usually what dictates COLA or the Social Security raises that you get each year, right? Cost of living adjustments. Well, it's funny. So normally what that CPI number means is that we're going to get an 8.6 to 8.9% raise next year for Social Security. But, I think what we're seeing is that the government can't really afford to have such a big raise, right? We're used to about a 2.5% average. For years, we saw zeros, where there was no inflation.
Yeah.
Well, now we're seeing just massive, massive inflation. So what the Federal Reserve Chairman's done by raising rates is, I've said it before, they're using a sledgehammer rather than a scalpel to cut out the problem. And it's going to have tremendous effects on our stock market, obviously, our housing prices here in Arizona. Just remember, we've seen obviously a huge run up in prices here in Arizona when it comes to housing. And a lot of that has been caused by a couple things. Number one, it's caused by low interest rates. Number two, the huge demand and flight out of places like California, New York, Chicago, Illinois, all of these high tax states. People want to seek refuge here in Arizona.
Yeah.
Well, when you take one of those things away, like low interest rates, mortgages are skyrocketing now. So, we're seeing, tremendous rise in long-term rates. And now obviously realtors are saying, hey, just do an ARM again. Nobody thought about doing an ARM in the last several years because, adjustable rate mortgages made no sense. You just tie it in for a 15 or 30-year mortgage and you're tied into this historically low rate. Well, now obviously, people are seeking lower rates. So for a lot of our clients, not only are we seeing pressures on that stock market, but the real estate market as well. And so when people are concerned about like, hey, what do I do? I've got all this, rental property assets, and people have always looked at those as kind of safe, long-term, investments. And there's some risk now, some value risk when it comes to that.
Absolutely. And Stewart, it sounds to me like we're in the perfect storm and on the brink of a recession. Would you agree with that statement?
Yeah, that's the big word people are throwing out now. And I really don't know what the hesitation is to just call it. I mean, I think it's here. A recession is technically, 2 quarters of negative GDP. What's gonna prevent that from happening? I mean, I see no indications that there's any help on the way. What's causing the issues are 2 things. Obviously, supply chain and oil prices. And, this administration is just not taking action to fix oil prices. They're releasing, oil from the strategic oil reserves. It's not helping anything. It's made no impact. Prices have risen even despite the pouring out of that. And now it's obviously putting us into a very, vulnerable position. The whole point of those reserves are for massive emergencies. Well, they could simply fix the problem by producing domestic oil here. There's I was watching one of the Senate hearings the other day, and one of the senators from Alaska he said, look, we've got 2 leases that are already signed, issued by Congress, but the different administrative, agencies are just holding up drilling. And that would be a huge resource for us to have access to. And listen, I love the wild. I love the desert. I love clean air. It's one of the reasons I moved from California here to Arizona.
Right.
I care deeply about our environment, but at the end of the day, if we're breaking everything around it, right? It's just it's like looking at what we did in COVID with all these lockdowns. They didn't work. We're finding out now that it was a complete waste of time to do lockdowns. It's the same thing that we're seeing here with green energy. It's just not, I just saw a special in Texas right now. What they are starting to discover is that wind farms don't work unless it's windy, right?
There you go.
I mean, what are you going to do? Have a bunch of people out there blowing on it to keep them spinning, right? And I think that's the same issue, is like these are technologies that will come on board over time, but they're trying to implement everything overnight. And so so long as oil is up high, we're going to be in deep trouble.
Sure.
It's an issue, and it takes time to build that infrastructure back after, they prevented it. So, yes, recession, it's coming, and I think people are concerned.
Well, Stewart, it sounds obviously very scary when you put it in those terms, but the most important thing, wouldn't you say, is to have a plan? Yeah,
no question. And I think that I would just say this, is that, people, first of all, need to know what their options are. And I think a lot of people are just misinformed about what kind of options exist. But, just rest assured, there's tons of options. Yes, the market's down 20%. Yes, we're in massive inflation, but there is opportunity out there to take advantage. Warren Buffett, his famous quote is, be greedy when other people are fearful, and be fearful when other people are greedy. And, to take advantage of the contrarian view. And right now there's plenty of opportunity if you take advantage of it. The problem, Cynthia, most people just don't want change. They don't make change. Even if they know they have a bad relationship, whether it's a bad marriage or a bad financial advisor relationship, they don't make change because it takes too much work to get out of it.
Yeah.
And what we're trying to say is we're trying to communicate that now is the time for change, right?
Absolutely.
And I think that right now, as these markets collapse around us, as things start looking worse and worse and worse, I am not a negative person, but I really, really think that, if things aren't working for you, if you're not getting communication from your advisor, if they're not proactively reaching out, then you need to get a second opinion on whether or not your portfolios are in a good position to benefit from where we are today. Mm-hmm. And are they looking at the taxes? When we come back, I really want to talk about how to really take advantage of where we are in the market.
Mm-hmm. Great idea, Stewart. I know you have a very special offer to present to the viewers at home today. Let's talk about what that is before we open the phone lines.
Absolutely. So what we're offering the audience today is that complimentary portfolio review. And in that complimentary portfolio review, what we're going to do is we're going to take a look at what kind of risks are inside your portfolio. What kind of fees are you paying? If you don't understand the fee structure of your portfolio, we'll let you know. Also, and I think as importantly, what are the tax implications hiding inside your portfolio? Are you efficient for the future? You have to take action. Give us a call at 833-652-7829, or even easier, pick up your phone right now, take a picture of that QR code on the screen. That'll take you to our complimentary portfolio review. Take action today. We'd be glad to give you a second opinion.
Stewart, thank you so much. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. We know you have a lot of questions for Stewart, especially right now in these very volatile times. He has the answers for you. He's offering you the complimentary portfolio review. When we come back, we're going to dive into what that looks like. And are you diversified enough? How do you know? We'll be right back momentarily.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is president of Asset Preservation, Wealth, and Tax. See, I had to take a second there because I'm thinking about it and all that good stuff. So, Stewart, obviously a really important show we're having today, talking about times like we're in right now. It's a very volatile market. We're talking about recession. My question is, how do people protect themselves during times such as this?
I think there's a couple key ways, Cynthia. Number one, you have to know your options. You know, we've been doing our TV show now for a couple years, and a lot of people say, oh, well, you know, that doesn't pertain to me because I'm still working. And what we're seeing right now is that people that are still working but have a few years left for, you know, until retirement, they think that they're kind of locked in their position. Well, one of the options that a lot of people have is when you turn 59 and a half, you generally have an option. If you have a 401k, you may be eligible to be able to roll that out into an IRA to have it professionally managed. Now, there are some downsides. Like, for example, you lose loan provisions. There's a lot of other things like that. But what it does do, Cynthia, is it gives you access to the kind of planning we're talking about. For example, when we start talking about Roth conversions, does it make sense? Well, you know, generally, it's really difficult to convert an existing 401k to Roth. What we do at Asset Preservation is, you know, once you're 59 and a half years old, you actually generally have the ability to roll it to an IRA, and then we can convert it to that Roth if it makes sense for you. So number one, I think you need to know your options. Number two, you need to make sure you're properly diversified. And I think this is probably the most misunderstood concept here is, you know, I'll see clients that come in, they'll have 80 different funds inside their portfolio, and they'll say, oh, well, I'm well diversified. Well, having a lot of funds doesn't make you truly diversified. It makes you have a lot of funds. That's all it does, right?
Yeah.
What you need to do is make sure that each of those different funds or stocks or bonds or whatever you have, they have different purposes. If they all move in identically the same direction, then they're all the same thing from a correlation perspective. They all do the same thing. So number one, you want to make sure your investments are diversified. And that's the first kind of diversification of investments. The second kind of diversification that we talk about is a diversification of tax class. So once again, most people that have 401ks and thrift savings plans and so forth, they've put away all this money tax deferred. But what they don't think about is that when they retire, they have to pull out all this money, you know, taxably. And all these years of growth, they all grow and you have to pay this big income tax bill. Well, that's a big concern because oftentimes people don't actually get to enjoy their money because they're so worried about the tax bill, right? Well, diversification of tax classes is important because if you have, for example, some of it in an IRA, some of it in a Roth, the Roth will give you access to tax-free capital when you're in retirement because, you know, taxable Social Security. Who wants to pay taxes on Social Security? Well, you start taking money out of your IRAs and 401ks, it's very likely that you're going to start making those assets that don't have to be taxable. So we've talked about diversification of investments, diversification of tax classes. There's also a diversification of perspectives, and that's super important at our firm. What we mean by that is generally when you go and you deal with a financial advisor, if you have your money in one mutual fund company, what we tend to see is that person sees the world only through their eyes. And if you're sitting across the desk from the guy that's picking the funds for you, that's generally not a great thing. And I'll tell you why. I am not the fund picker at our company. I'm not the one picking stocks and bonds individually for our company. We hire some of the best money managers in the world, in my opinion, to oversee our portfolios. We have the biggest money manager in the world. We have an algorithm money manager. We have David Young, who spent 14 years at the huge bond house in Newport Beach, California. So all of these guys see the world drastically differently. Let me flash back, for example, to November of 2020. Going into the election, half of America thought that if Joe Biden won, the market would do one thing. If Donald Trump won, it would do something else.
Yeah.
And your reality is all determined by what news channel you watch. If you watch the right-leaning show, you see the world one way. If you're watching most of the other media, you're on the other side.
That's true.
Right?
That's true.
And two different smart people can see the world drastically differently.
Yeah.
Don't you think that affects your money manager? Don't you think that affects your financial advisor? My question to you is this. If all of your funds are being picked by the guy sitting across the desk to you, I ask you one question. What if he's wrong? Are you going to bet your entire life's work that one guy is right?
Wow, good point.
Right? It's a tremendous risk.
Yeah.
And diversification of perspective is what's important, because we have some great money managers. Let me just tell you, one of them got it completely wrong here at the beginning of the year. Terrible. And they're one of the best money managers in the world, in my opinion. They've got it right for 5 years, and they've loved him.
Yeah.
Well, the biggest money manager in the world that we use, it has done a tremendous job. Well, now that role has inverted here. So now the algorithm money manager is getting it right. They're in a super defensive posture as this market continues to see 4% declines on a daily basis here. They're basically pulled off to the side and protected. The other ones are still steaming through it, getting punched in the mouth. But here's the important thing. You can't have all your eggs in one basket. And I'll just tell you, the most dangerous financial advisor is the advisor that thinks he's smarter than he really is.
Yeah.
The advisor who believes that he can be the asset gatherer, the asset manager, the money manager, the tax planner, all that stuff in once. The nice thing about asset preservation is we have access to our year-round CPAs and enrolled agents. We have them on staff to be able to do the tax planning. We have the money managers to be able to look at the money while I'm sitting here recording TV or visiting my clients. The markets are moving, right? They're not just stopping because I'm busy. Things are going on.
Exactly.
I think it's really important to make sure that somebody's watching all the time on their very specific job, and that's what we do. So it's important to have that diversification of tax classes and diversification of perspectives as well.
Absolutely. And let's talk a little bit about passive money management to tactical. That's so important as well.
Yeah, so what we started to talk about a little bit here was our algorithm money manager. They're a very, very tactical money manager. A lot of people for years have been invested in, indexes. And that's been a great pick for 12 years because the market has gone vertically up. Look, I'm going to break this to you very simply. A blind chicken could have made money for the last 12 years, right? You're not a genius because you did what the market did. You just, right? What do they say? Rising tides float all boats, right?
Yes.
Another Warren Buffett quote.
Absolutely.
Here's the thing. You got to know when to hold them and know when to fold them. And sometimes individuals are too close to their money. They play with two emotions, fear and greed. And I'll tell you, that's a really tough emotion or set of emotions to play with, because when you're scared, it's the worst kind of investor, is the investor that plays scared.
Sure.
And I'll tell you what, when we come back from break, what I want to do is go over precisely the kind of plans we have with regards to tactical and passive investing. But what we're offering the audience today is a complimentary portfolio review. And what I suggest, if you give us a call at 833-652-7829, we will take a look at what kind of fees are you paying, what kind of risks are you taking, and what kind of tax implications are hiding in the background. We'll also take a look at whether you're truly diversified. If you think you may have a diversification problem, then pick up the phone and give us a call. Even easier, pick up your phone, click on that QR code that's on your screen right now. It'll take you to our website, apsitaxes.com. Sign up for the complimentary portfolio review. We'd be glad to help.
Stewart, thank you so much. To the viewers at home, that number to call is on your screen. It's 833-652-7829. We know you have a lot of questions for Stewart about how to plan your perfect retirement, especially in these very uncertain times, if you will. Take advantage of picking up the phone today, 833-652-7829. We're going to take a very short commercial break, but we have so much more with Stewart when we return.
Your investment should reflect your concerns with the market. As prices continue to increase for everyday items, you may be wondering if your investments can keep up with inflation. Will your investment remain strong even if the American dollar weakens? Introducing the Foundation's inflation-sensitive portfolio, built on established corporate stocks, while including alternative investment focuses such as real estate, alternative currency, and precious metals to provide diversification. This portfolio seeks to provide you with a strategy that rises to the challenges seen across the market today. Invest in a portfolio designed as an answer to the growing concern of inflation. Discover more today.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio, and I'm joined today by Stewart Willis. He is president of Asset Preservation Wealth and Tax. Stewart, a great show we're having today, talking about such important topics, especially during these very uncertain times. I'd like to dive in a little bit further and talk about the tactical versus passive, especially tactical. Can you help shed some light on that, please?
Sure. So, like we were saying before, passive management is just simply investing in the indexes or kind of a buy and hold mentality. For the last decade, it's been fine because the market's done so incredibly well. But a tactical approach is much different. So there are tactical and strategic positions that we take. Now, we have one money manager who's identified 6 distinct stages in the economic cycle. And basically what they're saying is their algorithm believes that when certain signals present itself, for example, jobless claims, inflation, all those sort of things, all those economic signals, they basically rotate to certain positions. Think about this. In a recession, there are different investments that do well compared to if we're in a bull market, right?
True.
And so what you would think is that your money manager would naturally rotate you to that position if it made sense. But what we're seeing is that a lot of financial advisors and money managers are pretty passive, so to speak. They're looking for the least amount of work necessary to be able to, manage your assets. And maybe there's a strategy behind it, maybe not. But our tactical money managers, essentially, just to way oversimplify it, basically believe that, when things look good, they hit the gas. When things look bad, they hit the brakes. And if you're in the same portfolio today that you were 2 years ago, in terms of the way the underlying holdings look, that may be a big problem because 2 years ago, the market was going gangbusters. Today, we're in a completely different world.
Yeah.
Right now, people are concerned about whether or not, they're going to be able to still retire in a year or two or stay retired. Right? I've had clients that freak out because they're coming in and they're saying, look, my advisor's not calling me. I'm concerned about it. And they're just really concerned that they're going to be able to, live on this plan because they've seen a 20 or 30% reduction in their values.
Sure.
But I can tell you this, Cynthia, is when there's this kind of blood in the streets and this kind of carnage in the markets, there's usually some opportunity you can find. And the question is whether or not you're going to take advantage of that opportunity.
Okay. Stewart, I'd like to shift gears just a little bit and talk to you about taxes on Social Security. Is there a way to save that? Yeah, so one way to save it is to realize you first have to understand the mechanics of it. How is Social Security taxed? So Social Security is taxed based on something called provisional income. And what that looks at is all of your wages, all of your taxable earnings, any 1099s you have, any interest income, any 1099s you get from any of your IRAs, 401ks, any of that sort of stuff, capital gains. You add all that up plus 50% of Social Security. And if that number is over $25,000 as an individual or $32,000 as a couple, then up to 50% of your benefit is taxable, Social Security. Most people don't realize that it's taxable at all, right? And so what we do at Asset Preservation is we create a tax plan. Oftentimes it makes sense before you've filed for Social Security or even after you filed to really start saying maybe it makes sense to realize that we are in the lowest tax environment in history for the middle class right now. Real tax planning
involves taking action. And that taking action means maybe it makes sense to put yourself in the, if you're already in the 22% bracket, maybe it makes sense to push up to the top of the 24% bracket. Because guess what? These tax brackets are changing. At the end of 2025, as it stands now, the Trump tax cuts are sunsetting. And taxes are going up if Congress doesn't do anything. One tool that you have in there is looking at your existing IRAs, 401ks, thrift savings plans, and maybe it makes sense to consider doing a Roth conversion. Pay the taxes now so that when you start taking income out of your retirement plans, that it's not going to contribute to the taxation of Social Security. Most people will come into our office. They've done their job. They've put away $500,000, $1 million, $5 million into their retirement plans.
Yeah.
And they come in to plan this. But what they're not considering is the $1 million to $2.5 million of Social Security benefit they'll get as a couple if they live to their normal mortality schedule. So if you're worried about the $500,000 or $1 million you put away in your retirement, why aren't you worried about the $1 million or $2 million that you have come in from Social Security? It's very possible in many cases to reduce or eliminate the taxation on your Social Security if you have a plan. And just remember, the reason wealthy people stay wealthy is they have a plan and they take action. So if you are concerned about the future taxation on your portfolio, if you don't want to be in a position where you can't enjoy your retirement because you're worried about tax, then I think you need to take action today. And give us a call at 833-652-7829, or better yet, pick up your phone, click on that QR code, and all you have to do is sign up for a complimentary portfolio review. We'd be glad to give you a second opinion.
Stewart, it all comes down to that planning properly for retirement, and you're so amazing as you give guidance to the viewers at home. Thank you for another incredible episode this week.
Oh, thanks for having me. I have a great time here.
I do too. Thank you for having me. To the viewers at home, the phone number to call is on your screen. That number is 833-652-7829. We know you have a lot of questions for Stewart about how to plan your perfect retirement, especially in times like we are in right now. The number again is 833-652-7829. Thank you so much for watching the Asset Preservation Hour. We look forward to seeing you back 1 week from today. Be safe, be happy, be blessed, and take care now. We'll see you soon.